What's going on? Welcome back, everybody. It is Fed Day. It's Fed Day. Welcome back. It's going to be a good day. Going to be a long one. So get your popcorn, get your coffee, get your energy drinks, and
got mine.
That's it's gonna be a long one. So
I figure I might as well partake or die trying. So if I drop dead of a heart attack, you guys know why.
Yeah, if you see Mike fall off his chair for no reason at all during the show, it's probably because his energy drinks hitting him. So, but
What's up, boys?
Yeah,
what's
going on, guys? What's going on, Mal, Chris, Simon? Gonna be a good day. It was a good day of trading, actually. Really good day of trading for me. I just had some fantastic calls today. How about you, Mike? Did you trade today?
I did. Positive, but about 50-50 on stocks. It was kind of like 2 for 4, but the way I trade, it's the winners are a lot better than the losers.
Being positive on Fed Day is good. So
yeah, and I had a couple free market trades on the ES, which really carried me as well. So, I ratcheted down the risk a little bit. Didn't trade as much. I was a little bit more aggressive than I think I should have been in the stock arena, but that's okay. Just want to make sure I got bullets available. Bullets in the chamber for later in the day when we get some really good.
Yeah, exactly. I was sitting there and Bornlam was like, hey. I think gold's gonna have a nice bounce here. Winky face. Why don't you go trade? I'm like, Bornlam, I gotta save some ammunition for later during the stream, brother. You got a big day today. Trying to lure me into trading more. Bad man.
Especially when you're talking to somebody that thinks gold's sexy.
Yeah. Exactly. Yeah. But on top of Fed Day, we had a couple economic events and headlines overnight that caused the market to move. You had existing home sales, oil inventory numbers. You had Putin's speech last night that caused some movement. So we'll talk about that when you pull the charts up.
The Putin speech. If I think this wasn't a Fed day, we'd be down. We'd be down a lot more than we are. We're not down. We're kind of just chopping around in the same range. But the Fed thing was odd. The Putin thing was odd. First off, do you see that in Russia, Putin basically told the airline, look, don't sell any tickets to men 18 to 65, Tyler.
Yeah.
18 to 65, not selling any tickets, you can't leave the country. So he's basically, so what's happening today? Well, there's a traffic jam about 35 kilometers long at the Russia-Finland border.
Get me the fuck out of here.
Yeah, they're hell or high water. People try and get out of Russia. So, what do you do with that? And then, and then we have Biden. This administration, and please put politics aside because I'm not a Republican and I'm not a Democrat. I like to think that they're both full of shit, and I kind of filter somewhere in the middle. Now, I know kind of maybe lean a little bit more Republican, but that's because I don't like people putting their hands in my pocket and taking my money for taxes. But call me crazy. But anyhow, this has got to be the dumbest administration on the face of the earth. First off, every time they open up their mouth, they're giving some kind. There's at least $2 billion going out the door, Tyler.
Oh yeah, right.
Okay. What I want to know, is how do we get in line? Because next time Biden opens his mouth, I'd like some of those billions of dollars.
No, we don't. We don't get those.
Inflation is running rampant, and fiscal policy instead of tightening is to basically to go out and spend, cancel debt, spend, inflationary. And they figure the public's so stupid. If you just say it's the Bring Inflation Down Act,
right?
They don't care.
Okay, yeah, it makes sense. Yeah.
But let's get off the political bent here. Biden said that China is building up their nuclear arsenal, and they're doing it without transparency. So, they're just continually, we're trying to F with Russia, we're trying to F with China, we're trying to, kill the energy markets, and all at once take 50 years worth of infrastructure and, just kill oil, kill gas, and just, shove it down everybody's throat. And, we're just that's why we're looking at the long, cold winter.
Yeah.
So,
it's because we like giving over oil to Europe. We sent a lot of our SPR to Europe, so now we're stuck.
Yeah, and now nat gas we're sending so much energy, nat gas, over to Europe that we're now straining on our yields over here. So again, welcome to inflation never going away.
Yeah, right.
Because it's going to be just like the market, how the market seemed to always go up 2021, right? And it was just, all right, well, tech takes a breather, so we have commodities go. Commodities take a breather, well, we're going to have, consumer goods go up. Whatever. The market was always going up. Well, it's the same thing with inflation. The problem is inflation's always going to go up if you just keep on effing with something. So,
yeah.
anyhow.
Yeah. And then overnight, obviously you had a lot of movement in the dollar and oil, which is what sparked most of my trades. And for those of you who don't know, but probably do, Putin now enacted the draft, pretty much, military mobilization. So it's really starting with people who already completed their service in the military, and then maybe we'll see where they go from there. But they are now doing the draft to maintain stability in areas that they've already controlled in Ukraine. And so they're going to send them over to Ukraine and say, hey, guard this spot of land. Obviously, not a fundamentally changing event, so it was a pretty easy fade this morning. But that's what happened overnight.
Yeah, I mean, that's where you got to treat these events, these geopolitical events, sometimes with these news. That's just really, what else is really changing? I mean, does anybody really think Russia's going to send a nuke over here? I don't know, dude. I don't know. I talked about this in the beginning, how, what's the end game, right? And it just appears this administration's end game and Europe's end game is the destruction of Russia. And if that's the case, kind of you're packing them into a corner. And so who knows what's going to happen.
Yeah.
But he's obviously not going to go down without a fight. And the only thing it's doing is making this crisis, which should have been averted by now, it should have been negotiated out, it's making it last longer. And I think that's, to me, the biggest issue, because it's causing supply chain issues, it's causing shipping issues, it's causing energy issues, on top of the fiscal policies that we got, on top of the monetary policy that we got from the King Fed, Mr. Powell. So it's going to be interesting with what we got and where the world is now. And that's why it's so hard to hop into the bullish thesis, because, I find a hard time clinging to anything that is going to give the bulls some kind of fuel to go up, other than really the only thing the bulls are clinging to is we're oversold.
Right.
Okay? That everybody's bearish.
Right.
And everybody thinks we're going down and creating new lows. That's the only thing the bulls have, really. I mean, because, again, let's go into inflation.
Mm-hmm.
Inflation, sorry guys, is still going, it's still there. I mean, the inflation narrative went from transitory to its peaking. And so now we saw how it worked with the transitory folks. Okay, they got obliterated and created this mess. Thank you, Fed. And now we're into its peaking mode. Okay, I just don't see anything. I mean, first off, inflation, yes. The problem is people don't understand the CPI. They don't understand inflation because we haven't seen it in 20 years. I think I'm the only one in this room, in the chat, that actually has traded with inflation.
Yeah, probably.
Okay. Back in the 80s, there's 19%, 20% mortgages. You guys have no idea what you're missing. But anyhow, the point is that let's look at inflation. Used car prices are collapsing, right? They are coming down. That's good for inflation. That's what kind of, the inflation is peak narrative is saying. If you look at the manufacturing surveys, they're showing that prices paid through the surveys are falling, and that's important, right? But, rent, which is 10% of CPI, Redfin just came out, up 11% in August. Okay. Up 11% in August. Now, that is the smallest gain in a year, if you want to go into the narrative. But the problem is, think how long, the problem is it takes a really long time for that to filter through the economy and filter through to the CPI. And that's why we've been spot on with the CPI way back since May, right? Because the problem is most people just don't understand CPI, and they don't understand it's just not going to come down the way people think it's going to come down, and rates are nowhere near. Last time we had inflation of this narrative, and we talked about this, Volcker basically took the Fed funds rate up to 20%. Hi, we're nowhere near that.
No.
So, just be careful of the narrative you hear out there. Just like the narrative, well, we're not in a recession because employment is so good. Shut the F up, okay? Unemployment is a lagging indicator. The leading indicator is housing, and housing is continuing to shit the bed. Matter of fact, we had some housing numbers today. What were they, Ty?
Yeah, we had the existing home sales today, followed from yesterday's housing starts and building permits that we talked about, which were bad. Existing home sales still dropping, beat expectations, but they still dropped from last print. So previous print was 4.82, expecting 4.69 drop, and got a 4.8 drop. So dropped a little bit, but not as much as expected, but still on the tailspin here.
Yeah, it was a 7th straight month down. We're down 19.87 year over year.
Yeah, and that's the last time. That was, it's since 2007, right? And that most consecutive drops.
And prices are still coming down. Yada 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 yada.
Right.
So not good at all. Not good at all. So and by the way, you see Rubini came out. The guy that the guy that came out and predicted the housing bubble 2007, 2008. He thinks we're in for like a major crash, 40%, but they call him Dr. Doom for a reason.
All right.
But my big thing is, and let's go to the charts and stuff like that, because I want to really start digging into some narrative here as the markets, obviously are kind of selling off a little bit going into FOMC. Let's look at the charts, Ty, and we had some really good zones last Fed meeting. Trade against. Let's kind of look at that. Let's look at some of that stuff so we can kind of give people a guide of kind of what to look at here. First off, on the SPY, obviously the low for the week, this 380.54, 380.50 level, it's kind of the level I'm looking at, okay, on the downside. That's the level you want to see holding here if you're a bull, okay? We want to see that hold. If we break that, it's pretty much open air, don't you think, Ty? At least 372.
Yeah, if we're breaking lows and the market does sell off on this event, it's heading right to 372. In my eyes, yeah.
Yeah. So looking a little bit further, here's your 4-hour chart, Ty, that you love to analyze. Give us some analysis.
Yeah. So the way I'm seeing this. Is we obviously had the a lower low formed. We filled that gap, tried to push up, but we'll push back in this range. So we're obviously sitting in this range here, and this is a range that we don't really spend much time in as far as the tight range we're in. So my point being is, if we break these lows here, then 372 I think is without a doubt in play. However, we're creating somewhat of a bottom in here, and so I talked about this yesterday with Nick, and I said I wouldn't be surprised if if we get what we're expecting, the 75 basis point, yada yada. If we do break through here and give us that 38.2% retracement, because we still haven't technically created a lower high in this down move yet, and so basically. Out of this consolidation is, you got your levels. So it's just tough to say right now because I don't really know, how the market's going to react to it. So
I like that. So you're saying top end of the range, 392, right?
Right.
And then the bottom end of the range, really, as far as, what we don't want to see get lost is really this 380.50 level.
Right.
Okay. I'm writing those down. Anyhow, 15-minute chart, not giving us any. I'll tell you, the only hope I have really in here is the fact that, we got 1, 2, 3, 4 closes. If you want to go up to this range, 5, 6, 7, right? Okay, all within this sideways consolidation. And what's really good about this tightening and this consolidative pattern is that typically when it breaks the pattern, you're in for a good move.
Yeah, and that's kind of my point is like there's a lot. I think there was a lot of accumulation going on in the last few days here, and regardless of whether it's a good or bad print, I think that it's poised to really make a large move one way or the other.
Yeah, and that's the point. Bottom gap fill 378.57 for good thing for an alarm, and Saudi by nature says 394. Come on, Bulls. All right. Let's go, Bulls. Look, we have unlike Mal,
yeah, right,
and unlike Mark, we are not bullish and we are not bearish. We trade price action. So we're trying to keep a clear head here, but, you got to know your levels. And that's the key. That's really trading. It's just knowing your levels and knowing what it means and how the stock trades around those levels, right, Ty?
Yeah.
We always tell our mentorship group, look, you should be asking the question of who's in control and what does this mean? And they're really the two questions that you need to be asking yourself as we get into this, because this is a fundamental event that we're getting, which means that this is not a clearing event where we're just trying to clear it out and move on. Okay, this is an event where we're going to get some fundamental pieces of information that's going to be important for the market and for traders going forward. So we're getting this is like we're getting a piece of the puzzle, right, Ty?
Yeah, right.
So we're getting a piece of the puzzle, and I think right now. It's going to be important to see how the market reacts. And again, asking those two questions, really important. It'll keep you, just keep it basic. Keep it basic. And that's why we want you to know your level. As far as tech, you got this 293.54 level. And look, if we rise out of here, I think we could, 310 is easy, right? If for some reason we were to get a run out of FOMC. I think, not one day maybe, but I think, over the next couple of weeks, if we do get a positive event, you can definitely see a 310 run up in tech. Just as easy as you can see a 267 run to the downside. First off, before we get into small caps, if you look at the tips, real rates still, look at this drop, Ty.
Still dropping.
Still dropping. This right here is telling you that tech is going down the low.
Yeah.
This is not stopping. Last time we brought this to your attention, QQQs were here and the tips was here, right? And look, they've moved down, but so is the tip, so not really helping us out any. And we've gone through this chart 1,000 times. Pretty much it's worked out. It has worked out for a lot of different prices. Small caps, interestingly enough, kind of, where they had kind of leading us, kind of been weaker in here a little bit. So it'll be interesting. Still watching small caps to see where they take us. If you look at the Dow, you can kind of see just, down near, not near the low lows, but down near this little bottom of consolidated pattern here. Copper, I'm starting to look at copper again, Ty. Bornalon be excited about that, right?
Yeah.
Copper kind of falling off in here. Just watching it. It looked like it was kind of getting some momentum in here. Maybe we're not going to see a recession, but Dr. Copper's telling us we're not feeling too well. So I was looking at copper there, and I don't want to look at that. That's your chart.
Oh God, look at that.
Oh yeah, look at that big.
Mark,
stiffy.
close your eyes.
Yeah, didn't Mark say that I remember last week Mark said, "Oh, the dollar's going to lows. Don't worry, we've seen the highs for the year."
Yeah. Well, that's the bull.
I think
narrative.
Bornalon said that too, though. In all fairness.
Yeah, but Mark's a perma bull, so Mark wants the dollar to drop.
Yeah, well, that's true. Yeah, but so does Bornalon. Because he thinks gold's sexy. If you think gold's sexy, you think the dollar's coming down.
That's true.
Right?
It's true.
So, freaking dollar off here. Anyhow, 10 years still sitting up near highs. I mean, the 2-year, because Thinkorswim sucks, and I don't feel like going to a different chart system. I'm going to pull up the price of the 2 years here. I mean, it broke 4%, Ty.
Oh, that's right.
Here you can see the pricing, and to kind of show you the drop we've had in the 2-year from our pricing mechanism. And again, remember, inverse relationship, guys, right? So I'm just going to pull up a long-term chart in here.
Jesus.
This is a futures chart, so it's why it's kind of condensed in here. But look at this. So we had Jackson Hole somewhere in here, didn't we? Where was Jackson Hole? Up here. So ever since Jackson Hole, we've just so don't worry, Mark. I get half the crap wrong all the time. So.
Yeah, I'm just busting your balls.
That means you're a good trader.
Yeah.
Because if somebody says they get it right all the time, then you haven't traded. But I mean, look, with rates where they are, and the yield curve basically just all across the curve now we're inverted. Germany's yield curve is the most it's ever been inverted. Okay, mortgage rates are up over like 6.25%. I don't. I mean, look at it this way, guys. And the reason I brought up the 2-year is the dividend yield on the SPY, and Mal can correct me if I'm wrong, is like 1.7%. Okay.
Right.
Well, if the 2-year from the government is giving you 4% and your money's guaranteed. You guys got that? Okay? You're getting 4% for 2 years, 4% a year for 2 years. And your money's guaranteed, and you're getting a 1.7% equivalent over buying the stock, buying the market. Well, who's gonna buy stocks? Where are you going to park your money? Park it in the freaking 4 years. So at some point, what's going to happen with the Fed is if they are successful at convincing the market that rates are going to stay up, you're going to see the back end of the curve steepen, okay? And you're going to see rates rise along the curve with a focus on the back end, and that's going to be completely unattractive to investment, which again is another bearish case for stocks. So again, I every time I'm trying to find some wiggle room of what we're doing, but I just can't. Other than we're oversold, Tyler, and that everybody's bearish, I just can't figure it out. And the fact that we haven't gone down over the last week means nothing because nobody's positioning, nobody's trading before a major event, and so let's wait and see what we get with the Fed. But Ty, we did a pretty good analysis there of what's going on from a stock perspective, and I'll go over it again. Pretty much at 11:45, we're going to go through our Fed preview, and we'll go over those levels again to look at and what to look for in the markets. But more importantly, if you can kind of go through the dollar, kind of go through gold and oil, because I think they're important for us to really read what's going on in the market and how it reacts to the Fed as well. So if you can kind of touch upon those, that'd be great.
Yeah, definitely. You know, I think I was the only one freaking trading ahead of the Fed today. It's looking at the Dolores. We can skip the dollar tie. No. Oh,
skip the dollar. Come on, man. Big old stiffy bar on the dollar. We can't skip the dollar.
Bordelon, do you see my blue zone up here? You know how the dollar likes my zones, baby. So look, I mean, we talked about it on this dollar pullback here. There's nothing to even stack against it right now, obviously. And so I mentioned yesterday on the show that if we get this bullish close on the dollar above the consolidation zone, we could get a risk-off rally through highs into the Fed, and that's what we're getting. And so it's tough to say whether we rally. So, not Fed aside, looking at technicals, I'm going to tell you that this thing is going to keep marching. We're not overbought. We're not overbought on the daily. We are breaking through highs with some strength, and we're poised to close above, and it's going to give us a nice continuation. And we don't have resistance till 114. So technicals tell me we're going to continue higher. Fundamentals, Fed aside, tell me that we're going to continue higher. So whether the Fed knocks it down today or continues it or whatnot, whatever, I think ultimately we get a continuation out of here. It's just who knows what's going to happen with the volatility of the Fed and what they say. Because I really do think that with the 75 basis point, I think the dollar pulls off, off of that. But what's really going to be in my mind and what I'm going to watch for is, and I don't know we get much movement off of the decision. I think the biggest thing is going to be the dot plot and speech. And so I don't know if we, I don't know what happens today, but I do know that this bullish continuation is not likely to fail right now just off of what happens in the Fed. So I think that fundamentally we continue higher towards 114 as the first stop. Born on 130 in later 2023. Later 2023, probably not that late. What I would
You mean next week?
Yeah, right. I mean, look, so I want to preface this to say I wanted the dollar, and I was calling for the dollar drop around 104. I realized I wasn't getting it. I was wrong, so I hopped on the train of dollars going up. There's no reason for it to go down, and so my thesis is I think we hit a recession after the midterms. An official recession, because they don't want to hit it before midterms. I think we hit it after midterms. And then I think that the dollar gets a big pullback off of that, and we'll be, we'll hit 114, have a big pullback, big dump. And then I think we rally with the recession because the dollar rallies during the recession up towards 120, 122 area. And so I expect that to be beginning-ish springtime of 2023. That's my expectations. That's what I'm thinking. But as of right now, bullish continuation towards 114 is what I'm expecting. And, using that thesis, it allowed me to take some really nice gold and oil sells today. And, I mean, I don't even know what to tell you with the oil right now, dude, because this thing is just doji it's 4 dojis in a row with long upper and long bottom wicks, and it's just tough to read right now. And I was talking about this for a while now, is that we're probably going to hang out in this range for a while because we're so disconnected with fundamentals and the price, and so it's kind of hanging out. But you do have it's a really strong zone we're sitting in, and I think once we break it, it's going to be a nice continuation, because if you take a look at this bottom end of 82, strong area of support, it's where we're finding this previous low, it's where we're finding these wicks. If you look at 86, strong area of support, strong area of resistance, and that's where we're sitting. So 82 to 86 is a tough range to break, and there's a ton of accumulation going on right now in this range here. And so once we break it, we'll get a nice continuation. Oil is a tricky trader today. I wasn't going to stop my mid conversation, but once I saw that, it was just like it threw me off because I thought it was actually the easiest trader out of anything out there today. And I'll cover why because we have some time.
Uh-oh, laying down the gauntlet.
No, I mean, look, it's just like
I
want to be a little nicer to you because I've been trading oil a lot longer, but the way it works, that you'll notice is you took you took a long at 1, huh? A little late to trade oil.
Yeah, through that. Time to shut it down by then.
That's what I'm saying.
Hey, before you get into your explanation, Ty, I heard somebody was saying, it was one of these podcasts or something, but somebody was basically saying that they equated oil traders to the people that run the torture chamber.
What the fuck?
I don't know. Anyhow, just go finish your analysis.
I run a torture chamber.
Are you into torture, Ty?
I'm not even sure I get the analogy there.
Just go on. Just keep on running, brother.
Oh my god. And I actually filmed the videos about this. I was gonna put on YouTube later, but basically the way I saw it this morning was right. I was looking at it like right on, and I know you don't trade this early, so it's tough for you because you don't trade early. The best time to trade oil is early. But if you take a look at price action, we had this big move overnight, which was during the Russia speech. And as I mentioned, that's not a fundamentally changing news event. So when it's not, it always corrects itself. And if you look at the overall range here at 86 is my new pay attention level for the moment. It's the new level that it's the strongest area that it's going to reject. And we were sitting right at that level. I'm like, it's not going to break ahead of Fed. The dollar at that point at 7 o'clock was extremely strong. It was like right here, extremely strong. So oil's not going to break out ahead of Fed. Oil's not going to break out with a strong dollar. And oil's sitting at this really important 86.50 level. And so you saw overnight after the Russia speech that we had topped out. We pulled back, didn't fill the move, and we pushed back up towards highs. After we had created the lower high in a bearish engulfing, it was the easiest trade that I could have. It was like a layup, like a gimme. And
I love that.
And you could have known. Me too. You could have known that short here, stop above the high, look for a move to fill this. To fill that that move overnight. And I grabbed a 3.1. It was a 3-to-1 trade, and I had zero drawdown. So it was fairly easy today. Took some patience because I was sitting in it for 2 hours, but yeah, I mean my whole thesis behind the move today was the Russia thing overnight. However, looking at current price actions in the 4 hour, it's kind of just sitting in here. So whether we break 86 or 82. I think that's going to give us enough momentum to either drive it to 95 or down we go towards who the fuck knows, like 70. So, but yeah. So I don't expect the oil to break out today. I don't think it's enough of a fundamentally changing event for oil itself. But it'll probably chop around this range today. Gold. Gold was another really easy trader today. Had a short off of it this morning. Kind of the same thesis, but a little same thesis, right? This move here overnight was the Russia speech. Didn't fill it in the morning, and we were breaking through highs here, creating some divergence on the if I pull it down here, creating some divergence in the morning as well after we broke that high. And so after this bearish engulfing, or I guess I front run it a little bit, but after this bearish engulfing, I took a sell I was initially going to put a stop above the highs here, but I had let it go. I had my stops above the highs, but after I saw it pumping up pretty quick, I pulled my stop real quick because this move I watched it happen was really fast on the 1 minute. It always felt like a stop grab. When you see something move that fast for no reason, it felt like a stop grab. So I pulled my stop. I don't recommend doing that unless you're experienced. Pulled my stop, and it came right back down. And once you saw that wick, I knew it was going to go down. It just took a while. It took a lot of grinding. Ended up grinding down, filling that move almost to the T here. And I caught another 3-to-1, or well, it was around a 3-4-to-1 trade on this one on gold. Looking at overall technicals though here, again, we're sitting in this consolidation zone. And so this actually I do think will be enough of an event to break it out. A lot of accumulation going on in here, and gold's been moving pretty heavy. After these accumulation events, you have pretty heavy moves, right? Pretty hard extensions here. And so whatever the dollar does is what's going to be the inverse of gold, right? And so, I don't know what's going to happen, but if we see the dollar shooting at it, shooting through the roof here, you're going to see a nice drop in gold. And my target on gold to the downside, 1644 will be my first target, and then 1630 will be my second, depending on how much momentum we actually get. 1644 is a little close, so I'll probably lean more towards 1630 area to the downside. To the upside, I'll be looking for a move back up towards like 1700 if we do get a breakout in gold. And then crypto, kind of just it's up today. Bitcoin's up. It's actually breaking out right now, breaking through its highs. It's coming back up towards this resistance level. So I was watching this trend line. This intraday trend line here, last 3 days, broke it, retested it. We're running through highs now, and this 19666 is the area I'm watching here as the upside resistance. If we break through here, could have a nice squeeze towards 21,000. But it's just it's crypto, so not much really, really no legs or potential in it, other than maybe a squeeze or two. But now that's it for me. So I'll give it back to you so we can get prepared for the Fed in 15 minutes.
Awesome time. Good stuff. Good stuff. Okay, well, let's kind of get ourselves aligned in here with what we're looking for. So again, we want to kind of put in our little targets. This is the area right here that is an important area to the downside. This area right here, to me, the top of this upper zone is an important area to the upside. So that's kind of where you want to watch to see if, how the market is really reacting to the news. Because the market and the algos are going to be really on top of, explaining whether it was a good Fed announcement versus a bad Fed announcement. By the time you read through all the reports, I mean, the market pretty much is already taking care of its stance. Now, we talked about how to trade through the Fed several times. And, there's always the three moves. You got the original algo move, you got the reversal move, and then you get what the move is going to really be. And so, it's pretty good. What we like to do is kind of let that initial balance of the reaction kind of tell the story, right? Don't try to gamble and try to react and stuff. I know sometimes Tyler will go in and do some of the buy stop, sell stop. But, other than that, you really want to just kind of let the market react, create the range it's going to create, do your Fibonacci, and then see where you can trade and capture those moves. And we've been pretty good at trading the Fed and trading some of these good events. So we'll be doing that again through the Fed. We'll be sitting through. And don't forget, it's really, the statement is one thing, but it's the what do you call it, Ty? It's the question and answer session that really moved the market. And that's what happened. If people are wondering, the last Fed meeting we had was in June. I mean, you remember coming out of the June meeting, I mean, we kind of got this run up here on, basically Powell was saying, look, we're not going to give forward guidance anymore. We're going to probably start slowing down the increase of rates, as we get towards the end of the year. And the market just took that as completely dovish and ran with it, and ran all the way until we got to August, right? And then basically Powell had to come out in August at Jackson Hole, and he tore up his original speech, right? Because the market was sitting so high. He tore up his original speech, changed it to hammer the market. Okay. So, that should tell you something about, where the market is from a bullish tilt to where the Fed needs the market to be. Okay. I mean, and a couple of the Fed governors came out, were cheering the market decline in here, Tyler. I mean, actually cheering the market decline. So we always said, don't fight the Fed. Well, it also involves don't fight the Fed on the other side. Okay. So the key is, and this is a really important meeting. And I'm going to explain why it's an important meeting. We're going to get a lot of information. Okay. First off, it's a dot plot. So we're going to get the dot plot. We're going to get some more updated news, and it's now going to include 2025 as well. So now we're going to get information further going forward into 2025 as far as what the Fed's thinking. Okay. So that's really important. I mean, look, the first thing the market always looks at is the, basically the Fed funds rate. What's the size of, it's kind of like, every guy's nightmare, right? Well, what's your size? Which size are we going to? So, pretty much, I think you're not going to see a surprise here. 75 basis points, pretty much baked into the table. Nick Ruiz from the Wall Street Journal, who's the Fed leaker, he's pretty much been foreshadowing that. So I don't think we're going to see a size in that, a change or a surprise there. The only really possible surprise would be if they actually went 100 basis points. If you see that happen, well, I think could be a mixed reaction, because I think, maybe the Fed takes that they're going to try to front load rates, and that'll get us closer to getting through this cycle. But I think that the market heads down immediately off that. If we get 100 basis points, then maybe you get the bounce, and that could be the thesis from the bounce. You have to see how it looks. As far as voting, I think it's going to be unanimous. I mean, you do have Esther George and Lisa Cook out there that are quote unquote the doves and could have been dissenters in the past. We could see that Bullard, he's the one that could dissent and wants the 100 basis point. He's the ultra hawk out there. But I don't think the rate is really Mal's make me laugh. I don't think the rate really is the big deal here, right? I think, number one, what's going to be an increased focus is going to be on the terminal rate. Where are they going to reside and end up with the Fed funds rate? I mean, currently the market was pricing in like 3 3/4 to 4%. Now it's all the way up to 4 1/4 to 4.5%. And so, it's the market has, the Fed had priced in 3.8% through 2023, but now we may see a shift from 3.8 to the market saying to possibly 4.5. That's pretty dramatic. So higher, if that's higher, then that could be an issue. And don't forget, the Fed said they're not doing projections anymore as far as, forward guidance, but the dot plot is forward guidance. I mean, it means shit, right? They're always wrong, but this is the Fed's way. And that's what I was saying with the yield curve and rates. If the Fed, is serious about fighting inflation, they're going to come out and be super, super hawkish here. And if they come out with a dot plot which shows rates being strong through 2024 into 2025 and show a terminal rate 4 1/4 or above, then I think what that does is it steepens the curve. It's ultra bearish for stocks because you're going to see the long end of the curve, rates on the long end, rise and kind of catch up to the short end of the curve a little bit. And, that basically showing that that the Fed's serious. And I think you can see some of that stuff start pricing itself in as far as that's concerned. So that's something to look at, the terminal rate, a lot more than what the actual Fed funds rate's going to be. And then, of course, you got the dot plot. That's the next more important thing. The last one we got was in June. Okay. And we did have a Fed meeting in the middle. I forgot about that. But, and again, we're shifting to 2025. And I think what's going to be important is where are they at with GDP? Where are they at with the unemployment rate? Where are they at with the PCE and the PCE core rate? So the previous rates, the previous dot plots, we saw 1.7 GDP in 22, 1.7 23. Unemployment rate they had going from 3.7 to 3.9. So I think we're going to see, it's going to be interesting to see whether they increase that as far as seeing the unemployment rate coming up or not. But what's really going to be important is the PCE, because that's the Fed, that's what they follow. And see what they do with the core and the general PCE. I mean, they had 5.2% in 22 and 2.6% in 23, okay? And the core being 4.3 and 2.7. So that's going to be important to kind of look at going forward. What is, their projections? Because don't forget, we did last Friday get a consumer sentiment Michigan survey. And again, what's important about those is really the inflation expectations. And again, we saw inflation expectations come down. So that should be good going forward and help us in this battle. But ultimately, I think, we're set up for really Powell effed up. I mean, he really effed up the last time he talked. So I think he's going to want to be ultra hawkish. Okay. I see the risk to the hawkish side of things. If we get the 75 basis points and he's dovish, then Cathie Wood, the doors were going up. Okay. We're going up. I'd be shocked about that. I think the market would be shocked about that. But we'll have to see, right? Right now, the other thing for the bulls is the VIX, right? And we really haven't talked about the VIX. It's going to be one of the things you're going to want to watch today. But the VIX, I still think it's been very subdued in here. But the implied volatility going in its meeting is the second highest other than the June meeting. And I think the implied volatility is saying if we get that implied volatility through the end of the week, start to fall off dramatically, then that could be a mechanism that gives us a nice little fuel to the fire to the upside. So going to be wanting to look at the VIX and the implied volatility and see what we're getting out of there. But, when you're talking about gold, I could see gold just swooning from here down even more if they stay to their hawkish pill.
Yeah.
We're going to have to see. So now the typical reaction we get on a Fed day, guys, don't forget, is usually where, Ty? Up, right? And matter of fact, on average, 1.4%, we typically go up on a Fed day, okay? Matter of fact, 3 of the last 4 days, we've gone up 2% or more. So, but what happens typically after that?
Yeah, we rally down.
We can go back down. So that's what I'm kind of looking at here. I think we got a good basis what to look at. Welcome in, Mo. Yeah, they do follow the PCE more. But, I mean, it's going to be interesting to see. If you're bullish, okay, and I just wanted to kind of bring a couple other things up. Well, we'll get into that more. But there's some things to look at, okay, if you're looking for a Fed pivot. But I don't think we're going to get those things. So we'll go over those things once we have the number out. We'll have some time to kind of analyze the reaction and stuff like that. But right now, I did want to pull up the ES, okay, and kind of give you guys some levels on the ES that are trading futures. To me, to the upside, again, this 3,900 level and 3,905 level has really been the line in the sand here for the Fed. So, and not the Fed, but for the ES. So, but to the upside, if the bulls are going to hold and we get an initial algo reaction down, you want to see this 38.55, this 38.53 level hold. Okay, this is an important level. If you're bullish, if you do get that initial drop down, you want to see that hold. You don't really want to see a break. The next level down, to me, I have is a 38.35 level is a level to look at, and then you got in the 3700s. To the upside, 39.25 to 39.27. Actually, excuse me, 39.22 to 39.27. Right in that range is what you're going to first level up, and then if you kind of go up a little bit higher, this double. This is a really major point of control here. This 39.55 to 39.53 level. So that's what I'm kind of looking at on my levels on the ES. Excuse me, the SPY. Kind of already gave you your levels on that. So, and I'm going to bring this chart up so we can kind of follow the reactions together. But, yeah, it was. So we'll have to see what we get. We'll kind of follow this together. Got about a minute, 2 minutes until we get going. Guys, if you guys are having to, want to help us out, man, make sure you hit that like button so we can, keep on doing this. But look, I like where we are here. What do you think, Ty? I mean, I got the VIX here. Going to be following the VIX. I got the dollar here. I got the 10-year rate. I mean, there's a couple other things I'm looking off screen, but I think right now you can kind of get a good view right in here.
Yeah, it's going to be interesting that both the dollar and the ES are both sitting at their highs of the day. So one of them is going to divert. So I guess we'll have to see which one it is.
Yeah, one of them's going to divert. Well, you got a lot of shorts getting out of. You got a lot of longs getting out of positions. You got a lot of, you get a lot of mean reversion because you do get some of that stuff pop in.
Wouldn't expect this 2 o'clock move to really sustain itself, especially because we have press conference ahead of us.
Right. Well, we did. Yeah, I mean, you're going to get a movement.
Right. You're going to get a movement. I just don't know if it's going to be a directional based.
And we got about 30 seconds.
30 seconds.
30 seconds, baby. Let's go. Time to go, buddy. It's time to make this happen
baby.
Here.
Woo.
So again, you're going to let the initial reactions kind of filter out, guys. Don't get chopped up in the volatility as far as that's concerned. Let the algos do their thing, and let's.
All right. 5, 4.
Spread this
3,
out a little bit here.
2, 1. Ding, 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 ding.
All right.
What do we get?
First reaction down.
What do we get? Oh, look at that drop.
It's not much. Remember what I said. We want to see that 55 level hold, and we haven't even come close.
We got 75 basis point.
75 basis point to 3.25%. Not bad.
I want to see the dot plot.
Up, getting a nice big candle down now.
Look at the dollar.
Yeah.
There's the diversion I was looking for.
There you go.
They voted 12 to 0 for the actual. So the Doves actually went to 75.
Jumped on board. So
that's interesting.
Look at the 10-year above 3.6. So VIX kind of spiking up here. Let the markets react. We got our level down here to kind of watch, guys. This 38.55 level. So let's
the Fed did
see
say
that kind of hold.
Ongoing rate hikes are appropriate.
Ooh, Fed median forecast shows rates of 4.6 in 2023, 3.9% in 2024. That's not bad, 3.9%. Ongoing rate hikes are appropriate. All right, so here was your first dip buy. You got this nice little candle through this level, guys. So that gave you your first mean revision trade here. Look how this level played to the T, Ty.
Yeah, that's nice.
Look at this. Who's giving you the level? So, first trade out of the gate. Taking first trade out of the gate, guys. Let's go, man. We're rocking and rolling here. 20 points. I don't know what else you want. All right, I'm taking some profits into this. Well, all right, so Fed funds rate median view for the end of 2025. 2.9%. Great job. Guys, we should be done. $50 a point, 20 points. This was in 2 minutes, $1,000 trade. I don't know what else to say. I'm going to take my shirt off and run around.
Inflation of 5.4%. Damn.
So I'm still going through this. Ty, if you can find the if you can put the report, drop the link in there. Sees inflation of 5.4% at the end of 2022. That's up 0.2%. Okay. 2.8. All right, so we're up 0.2% across the board, guys. So it's 5.2, 2.6. They got 5.4, 2.8%. So they have adjusted their inflation expectation. Fed funds median rate at the end of 25 is 2.9%. That's a little surprising.
Dude, the VIX is off your chart.
Oh my God, where'd the VIX go?
Where'd the VIX go?
Guys, you see, holy moly!
Shit! Look
There's
at the
a little
VIX.
capitulation coming a little bit.
Dude. All right,
okay.
Marcus going to lose.
This is why we took our profits in here, guys.
Damn.
Okay.
VIX said, "See ya." Wow.
All right, the 2 years, dude. The 2 years up to 4.11.
Wow. Wow.
DBO volatility just jumped 11%. The VIX jumped 11%. Wow. All right. Well, we had the easy trade, so let's we just made $1,000, so let's just kind of hang in here a little bit. All right. So the projected median Fed funds rate at the end of 2022 is 4.4%. That's high. That's why we're getting this initial sell down here, guys. Dude, that went up from 3.4% with the projection in June. It's now 4.4%. All right. So what I said about the bond market, we're getting. You're kind of getting a little of that in here. So I'm not ready to buy this. Yeah, even though it looks like you're getting some. No,
we had a lot of stuff come out just now. I didn't realize all that. We had so many changes.
Yeah, well, that's what we were saying about with coming from the dot plot.
Right.
So 2 10-year yield curve inversion to minus 50 basis points. That's up.
Damn.
Wow. Yeah, we got a lot of stuff going on.
Yeah.
This is wow. All right, so you can see why we didn't buy this here, guys. Right now we're if you're bullish, we broke the bullish level. And look, guys, we went right down to my second level, Ty.
Yeah.
So if you took this short in here, I'd be covering right in here at the bottom of this zone.
Wow, this is incredible.
Nice reaction, nice long bars down on the market. So don't worry. You bulls should not be slitting your wrists yet. Okay. Look at this nice little bounce out of here, Ty. So if you took this short, I mean, our levels are playing out to the T. So it helps to know your level. Bears, don't get carried away. Now, look, Theo, I'm not buying any reverse until we get back above 338.55 level. So that's, we really need that to hold for the bulls. So right now, I'm not buying. I still think we could have some more downside capitulation possibly. I mean, the VIX is off the chart.
Dude, did the VIX halt or something with the?
Yeah, the VIX is off the charts.
The hell even?
Yeah, so it's not a time for Mal to start posting pictures of the Bears in the pool party. And it's not time for Mark to start claiming we're going to 4,500. So, Fed war in Ukraine pushing inflation further higher and hindering global economic growth. Higher food, energy prices, and broader price measures. Just trying to filter through. Ty, were you able to find any of that stuff? VIX, look at the VIX coming down.
This is great. Nobody has any idea of what will happen in 2024, and look at the dot plot.
Right.
Oh my God.
So, This is interesting. I didn't think I've ever seen the VIX active.
I don't even know what's going on with the VIX right now. It's like
Summary of economic. Oh, here it is. Did you post it, Ty?
no, I was just looking at it on Twitter.
There we go. We'll post it to you guys that. Oh, it didn't go in as a link.
Oh, I think only I can do that.
All right, why don't you do that, Ty?
All right, let me find it.
All right, I'm just still trying to filter through, guys, through what we're seeing right now. Very muted market reaction now. So, very muted market reaction as far as what I'm seeing. We're seeing the VIX come off. I'm not interested in buying yet. I mean, we had such a great trade. All right. Actually, I think the volatility is not crazy at all. I'm not seeing us. We're kind of, we're really trading. Remember what I said, guys? It's not only knowing the levels, but who's in charge. What does this mean? So we're now kind of getting rejected. If we get rejected off this 55 level, that might be a good short. But it looks like if we break through, then what I'm looking for is a break above, maybe back up to here, come back down, test this level for support, and then go. So bulls back in charge. Bulls reclaim the 55 level. So again, this is not much of a drop. This is almost nothing. So I'm liking the react. If you're bullish, you got to like the reaction that we're seeing here. So Fed swaps indicate terminal rate of more than 4.6 this cycle. Yeah, I mean, we're seeing inversions increase all across the way. We're seeing the medium. The only thing that's kind of helping the bulls out here, and I'm gonna do it. I'm gonna go into a clean area here, clean chart. All right, so what I'm doing, guys, in here now, okay, we've created our initial range. So I'm pulling a Fibonacci in here. And so the important level to kind of watch is, if you're looking at this, is this 50% level. Oops, sorry, I didn't mean to put that twice. So watching to see if they can come back down. And what's interesting is you got this 30, 38, 55 almost. Yeah, so, let's see if 38.55, if they bounce it off 38.55, then maybe we get a run up. I'd be watching this 50% level, which is 38.68. That's going to be an important level, from a Fibonacci standpoint. So we're going to be kind of watching that. And we're kind of bouncing off this 55. So I'm going to take here. We still have VIX down. We have the rates kind of falling back down dollar. I'm going to take a stab. I got an order in here just to get a small bounce. I got a short stop loss. So I'm in long. If we break this 33 level, I got a very short stop loss. I'm out. So we'll see if we get a bounce. Plus, from a time perspective, if we don't bounce out of here relatively soon, I'm going to be out. So I'm in bullish here, so we'll see. Currently up 4 points. Dollar's falling off pretty good, though. So let's see. It's got to hold this level or else I'm out. I got a hard stop sitting down there. I'm not moving my stop. What do you think, Ty? I mean, we got the VIX kind of very, very just hanging here, and we got rates fall. You got rates falling off. You got dollar kind of falling off from its initial run up. What do you think?
I mean, I personally like the bounce here. I didn't expect this to have it's going to run away before the Q&A. And so
exactly.
Where it's at now, this previous wick that we're sitting on top of, which is more or less your zone here, is it's the area I'd be watching here. And the fact that we came back above, and we're retesting it now, gives me the idea that we're going to rally back up towards, where...
No guarantees, though.
Yeah, no, I mean, that's just an idea. So it's really at the area that I would want to see a bounce from, and it's just.
All right, let's go. Come on. Get a little bouncer off the mount. Yeah, look, we had such a nice trade out of the 55 area that, all right, not happening. I'm out. So they're probably going to run a wick on me and then go, but that's okay. I want to protect profits here. So those of you that, were, oh, well, the SPY's not in, S&P 500's not in a bear market. It's down 20% since January. That's peak and color. So we'll see what that means. Yeah, so, not ready to bounce yet. You got a nice little trend line to kind of watch here now. Actually, I kind of like this a little bit. Because you know what I like about this guy? Is this intersection is right here at the 55 level.
Right.
So we'll watch it. It's very calm trading, Ty.
It seems very calm. Market? It seems very, very calm.
I mean, very calm trading. No reason. Look, we had a great trade off here, guys. Great trade. I mean, you get 15 points on the ES. Just book that, and you don't want to trade it away. So you don't want to over trade. A lot of traders do is they over trade their positions, and next thing you know, they end up with not much. So Euro extends losses, good stuff. Mal hits fresh 2-decade low. Still not back up to parity, huh?
Oh no, fuck! Just died through parity.
Well, and I think a good point, Mal. So no cuts in 23. That right there should kill the bull thesis.
Right. Yeah. Exactly. Right.
So basically, we went from 4.25 to 4.4. Yeah, I mean, what I'm looking on here, look, the Fed's in danger of breaking some shit now. And that's the problem. Okay? Fed's in danger of breaking some stuff. And so, guys, look, you can see this is great. This is why we always look for that retest, and you want to see the retest hold. And that's why that was beautiful. So now, if we break this level, the next level, my next target zone level, where's my next target zone level? Hold on one sec. I thought I had it highlighted out. Because it was 3780 was my next target zone, which really would be, I think, you can look at 3830, you can look at 3800. It's going to be important levels to the downside. Yeah, bond market might do their own thing. I mean, I'm kind of looking here, 10-year, nice little spike to 3.6, 10-year, back to the, coming back to the scene of the crime. We always talk about it. You always want to know where the scene of the crime is, becomes an important level when you're trading. What I mean by the scene of the crime is where were we before we got to the news event? So I'm going to kind of clean up this chart a little bit for you. I know I got a lot of levels going on, but it's important to kind of see. Some of these are mislabeled, so don't pay attention to that. We're just looking at some important levels here. And I don't know. What do you think, Ty? I mean, very, very calm reaction.
Honestly, I like to retry the buy here.
Right in here?
Yeah, I mean, potentially creating a double bottom at that point of control.
Good point.
You have a short stop loss if it breaks those lows, you're out. But I think the potential to the upside on a bounce here is better. It's like you said, it seems very calm right now. And I don't know if you get that second leg down until you have the press conference.
You're getting the reversion back on all of this. You're getting reversion back on the 10-year. Now filled its gap. You're getting a reversion back on the dollar.
Right.
which is nice. Well, not complete reversion from where we came out.
Starting.
But, nice little reversion out of here. Let's see if these levels hold in here.
Right.
Just remember, yeah, TLT is kind of pumping a little bit in here. I'll put a little order hanging out here in case it decides that we can pump through there. Because I'd like to get a little confirmation in here. But, again, we came out of the gate with such a strong trade. We don't want to trade our profits up. Just crazy. So, we got some more in. So, let me see. We still have the Bank of, the Bank of England later this
tomorrow.
Tomorrow. So, that's going to have an effect here. The key is where all this stuff. Look, everybody's waiting now for Powell to do his speech. We're going to cover that live. We'll trade through that as well. So, right now, sitting at 15 net profit points in the ES. So, nice day trade, guys. Tyler's kind of lining a trade up for us, maybe if we can bust it here, right, Ty?
Yeah, if it holds here, it's the risk reward's looking nice, but see if it holds.
Step out just for 1 second.
Getting a little bit of a pop here. So let's see if we can rally off these lows here. Yeah, Borderline, I was watching that gold dip. It was this thing almost completely filled that move down. So I think that's why I think we get a little bit of a pop here in the ES. It seems like it didn't really get that extension out of these lows, out of that dip here. And I think if we can get the dollar to roll over a little bit, probably get it. What is oil doing? Oil's at lows. Oil's at that 82 level. Oil could have a nice dip by soon. Yes, trying to bounce off these lows here. I think we get a nice run back up towards like 38.65 at least. I think we get a nice at least 20-point move off these lows. Potentially more through 38.70. Get a nice little bit of a squeeze in here. Again, I think you get at least 20 points out of this move here. The lows were a nice grab.
Wow, it's nice to come back and see that my buy order got executed.
Yeah.
Let's hope I make some money.
Right. I think you can get a nice little squeeze out of here, at least 20 points.
Well, let's see.
You got 10 minutes left. I'm going to grab a drink real quick. You got to turn your camera, turn your camera back on so people can see your lovely face.
They don't want to see me.
They want to
They don't want to see me. Trust me, Ty.
Oh, man.
All right, well, let's see if we can rally out of here. I'm in, so. Nice little nice action in here today. Hey guys, if you guys, I'd like to do a little survey. If you guys think that we're gonna end the day up, drop a 1 in the chat. If you think we're gonna end the day down, drop a 2. Just curious what everybody's thinking. 1, if you think we're going to end the day up. 2, if you think we're going to end the day down. And 2 switches out the bullpenning. Yeah, I got you, buddy. All right, look, Mark, of course the bulls all ones, man, all ones. Come on, let me know, man. 1 if you think we're we're going to end the day up. 2 if you think we're going to end the day down. Everybody thinks we're going to end the day up, man. It's awesome. I'm taking, so just for my trade in here, I'm going to take some profits if we can get up to this 53 area. Would be nice. 2 against the odds, of course. Oh, look, our resident bear said 1. Man, even got the bears. That means I better sell out of this position if that's the case. All right, so if you're in this trade with us, I would move your stop to break even. I mean, we don't want to trade ourselves out. Again, we want to protect the profits we made. So we had 1 trade in here, lost 2 points, from the profits. So I'm not willing to really chip away. I want to save my profits and I want to save my bullet for what we got going forward with the with what we got going on with when we get to the news event as far as the question and answer session with Powell. I think that's where we're really going to have. Never mind, too. Simon, we're going down. Love it. Aaron going down. Theo doesn't know what. Theo thinks we're going down 4 times. So, love it. So, kind of hanging in here. I really would have liked this bounce to really get some traction. This is what I kind of talk about when we don't get, this light volume in here. So I got triggered in here at 41.50. If you're anywhere 43, 44, I mean, I think, right now 42.50, you don't want to see that come back into play. I'm almost inclined to take my profits because then I got, back up. I just don't like the fact. Look, I mean, buyers just aren't showing up in here. Volume's starting to just taper off, and you need buyers really to kind of push us out of this mode. Kind of watching some of the other, trying to get a clue. If I'm looking at the tick, we're off. At least we're back, at the 0 line on the tick. Breath is just disastrous, obviously, as you would expect. All right, here we go. We're starting to get a little bit of a push up in here. Get me to 53. And oh, there we go. There we go.
Oh, this is the level. See? Come on, baby.
All right, baby. Tyler called it in. Positive trade number 2.
Come on.
Sorry, I'm taking my profits, baby. Take my profits. So, all right, we just added 11 points on top of the 20-point win we had. Excuse me. We were net 15. We just took another. What's the net? That is calculated profit. 10. So we're up 25 points. 3 trades. 25 points on the ES.
Man.
Good job, Tyler. I'm glad I put that on. I had to go to the bathroom just like you. I'm glad I put the. I'm not drinking these energy.
Yeah, dude. I just went to go take a massive dump. The Fed stressed me out. And I don't know if it's the Fed or this energy drink's going right through.
JT's like, I want more. Gotta love JT. You're probably gonna get it. Look, I'm the scaredy cat trader of the group, so I'm gonna be taking. I'm gonna wait to see if we get a breakout here. And then come back and retest again and then maybe go. I don't know.
Scaredy cat of the group.
I trade. Look, I admit it. I trade like I'm a scared little schoolgirl going into the schoolyard.
Well, when you left, I called out 38.63, and that's where we're headed.
Well, I wish you would have told me that time. Heart rate off the roof. Yeah, I mean, look, you got TNX dropping. This is all good stuff. You got VIX dropping. We have the dollar dropping. Guys, this is...
we talked about it. You wouldn't expect it to run before the press conference, so now we're all reverting back to where we left. So we could pretty much start fresh.
Hey, how well has our levels been, guys?
Right.
Where's my 2 brown dogs? My 2 brown dogs in here?
Yeah, where the hell is the 3 brown dogs?
No, it's 2 brown dogs. It's not 3. He's got 2 brown dogs. Come on, I thought I saw him in here earlier. Where's my 2 brown dogs?
Yo.
Simon, give me a little fist bump. Are you how you doing? You making some money in the futures here, Simon?
Oh God, Mark's back.
Here we go. Mark's calling the top.
Oh, 3 brown dogs is here.
Yes. 2 brown dogs. Come on. 2 brown dogs. All right, so you see these levels, man. 2 brown dogs, one part of our mentorship group. So and you know, you see these levels, nice trading off these levels in here. So you know, good learning lesson. Good learning lesson. I don't know, Ty. It looks like I'm winning. Of course, I did miss. I got out 53. It went to 58. So
You went to 61.
it went to 61. See? That's okay. I'm good with that. We're gonna watch it with popcorn here. Probably best for everybody. You probably shouldn't be trading this, but I'm telling you what, very, very low action here, man.
Right?
30. So not seeing much in here. We're now getting these negative ticks. We're now minus 750 on the tick, so be careful there. Oh yeah, hey, I remember when Orange County declared bankruptcy. That really effed the muni bond market. I was trading back. That had to be back in the 90s when Orange County went and declared bankruptcy. Right, Bornalon? Tell me if I'm right.
If you want to stop sharing, we have 1 minute left, and I'll bring us over to our FOMC view.
Oh, is it getting ready to start?
It is getting ready to start. And where we at? All right, share.
I'm really off.
We are 40 seconds away.
True that, Boomer.
Look at that pretty elevator music we got for the pretty elevator music for the video. Alrighty.
It's pretty elevator. All right, come on, buddy, pal. Let's make it work.
Right, 15 seconds. Come on, buddy.
You do have Janet Yellen in there, right?
Oh yeah, I gotta pull us up there. I forgot we gotta join Yellen. I forgot.
Oh, who cares? As long as Yellen's in there, that's the best.
Right.
You know, we don't want to mess with success.
That's true.
We don't want to mess with success here. All right, I'm going to switch my charts. Sharing it. Whoop.
All right, let's go,
Ty,
J-Pal. What's up?
On your ES chart, can you highlight with a box some level?
Yeah.
Okay, 38.55. Just put a nice little box between 33 and 55 in there for us.
I'll put a box after I do lines.
Okay, and then 40 to 35.
40 to 35. Okay.
And a nice little box in there. Oh, here we go, guys.
Good afternoon. My colleagues and I are strongly committed to bringing inflation back down to our 2% goal. We have both the tools we need and the resolve that it will take to restore price stability on behalf of American families and businesses. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC raised its policy interest rate by 0.75 percentage point, and we anticipate that ongoing increases will be appropriate. We are moving our policy stance purposefully to a level that will be sufficiently restrictive to return inflation to 2%. In addition, we are continuing the process of significantly reducing the size of our balance sheet. I will have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy has slowed from the historically high growth rates of 2021, which reflected the reopening of the economy following the pandemic recession. Recent indicators point to modest growth of spending and production. Growth in consumer spending has slowed from last year's rapid pace, in part reflecting lower real disposable income and tighter financial conditions. Activity in the housing sector has weakened significantly, in large part reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment, while weaker economic growth abroad is restraining exports. As shown in our summary of economic projections, since June, FOMC participants have marked down their projections for economic activity, with the median projection for real GDP growth standing at just 0.2% this year and 1.2% next year, well below the median estimate of the longer-run normal growth rate. Despite the slowdown in growth, the labor market has remained extremely tight, with the unemployment rate near a 50-year low, job vacancies near historical highs, and wage growth elevated. Job gains have been robust, with employment rising by an average of 378,000 jobs per month over the last 3 months. The labor market continues to be out of balance, with demand for workers substantially exceeding the supply of available workers. The labor force participation rate showed a welcome uptick in August, but has little changed since the beginning of the year. FOMC participants expect supply and demand conditions in the labor market to come into better balance over time, easing the upward pressure on wages and prices. The median projection in the SEP for the unemployment rate rises to 4.4% at the end of next year, a half percentage point higher than in the June projections. Over the next 3 years, the median unemployment rate runs above the median estimate of its longer-run normal level. Inflation remains well above our 2% longer-run goal. Over the 12 months ending in July, total PCE prices rose 6.3%. Excluding the volatile food and energy categories, core PCE prices rose 4.6%. In August, the 12-month change in the consumer price index was 8.3%, and the change in the core CPI was 6.3%. Price pressures remain evident across a broad range of goods and services. Although gasoline prices have turned down in recent months, they remain well above year-earlier levels, in part reflecting Russia's war against Ukraine, which has boosted prices for energy and food and has created additional upward pressure on inflation. The median projection in the SEP for total PCE inflation is 5.4% this year and falls to 2.8% next year, 2.3% in 2024, and 2% in 2025.
I took 10 points.
Participants continue to see risks to inflation as weighted to the upside. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. But that is not grounds for complacency. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation.
Chicken shit.
We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by 0.75 percentage point, bringing the target range to 3 to 3.25%. And we are continuing the process of significantly reducing the size of our balance sheet, which plays an important role in firming the stance of monetary policy. Over coming months, we will be looking for compelling evidence that inflation is moving down, consistent with inflation returning to 2%. We anticipate that ongoing increases in the target range for the federal funds rate will be appropriate. The pace of those increases will continue to depend on the incoming data and the evolving outlook for the economy. With today's action, we have raised interest rates by 3 percentage points this year. At some point, as the stance of monetary policy tightens further, it will become appropriate to slow the pace of increases
Oh, here
while we
you go.
assess how our cumulative policy adjustments are
Here you
affecting the
go.
economy and
Slow the pace
inflation.
of
I'm in.
increases.
We will continue
I'm
to make
in.
our decisions meeting by meeting and
Come on.
communicate our thinking as clearly as possible.
Well, that was the trigger. Let's go.
Right?
Restoring price stability will likely require maintaining a restrictive policy stance for some time.
Don't say restrict.
The historical record cautions strongly against
that
prematurely
you're gonna
loosening
rate-
policy.
Loosen up.
As shown in the SEP, the median projection for the appropriate level of the federal funds rate is 4.4% at the end of this year, 1 percentage point higher than projected in June. The median projection rises to 4.6% at the
Basically,
end of
in
next year and
2024, they have
declines
no idea what to
2.9%
expect.
by the end of 2025,
Come on.
still above
Blow
the
us outta
median
here.
estimate of its longer
Need
run
another
value.
10 points.
Of course, these projections do not represent a committee decision or plan, and no one knows with any certainty where the economy will be a year or more from now.
All right. I'm not liking they're not.
We are taking forceful and rapid steps to moderate demand so that it comes into better
Come on, right here.
alignment with supply.
Candle. Come on, baby.
Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a sustained period of below-trend growth, and there will very likely be some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. We will keep at it until we're confident the job is done. To
There's the
conclude,
job
we
is done
understand that our
campaign
actions
trade.
affect communities, families, and businesses across the country. Everything we do is in service to our public mission.
All
We
right.
at the Fed will do everything we can to
Chicken's
achieve
getting
our
ready to get
maximum
out,
employment
Powell.
and price stability goals.
You get out
Thank
so
you, and I
everyone
look
else
forward
can
to your
get in.
questions.
Exactly. All right. That's it. We're into question.
Oh,
Oh,
Hi,
shit,
Chair Powell.
I'm
Thank
out.
you for taking our question.
right. Oh,
Gina Smiley
good.
from the New York Times.
Yeah,
I wonder if you could
once
give
I
us a
found
little
that out, you
detail
gotta get
around
out.
how you'll know when to slow down these rate increases
All right,
and how
mine's
you'll
3
eventually
points on
know
that.
when to stop.
So I will answer your question directly, but I want to start here today by saying that my main message has not changed at all since Jackson Hole.
oh,
The
Here we
FOMC
go.
is
Oh.
strongly resolved to bring inflation down to 2%, and we will keep at it until the job is done.
he saw the
So,
market and said
um,
shit.
The way we're
Yeah,
thinking
he saw
about
the
this
future.
is
Right.
the overarching focus of the committee is getting inflation back down to 2%. To accomplish that, we think we'll need to do two things in particular: to achieve a period of growth below trend, and also some softening in labor market conditions to foster a better balance between demand and supply in the labor market. So on the first, committee's forecasts and those of most outside forecasters do show growth running below its longer run potential this year and next year. On the second, though, so far there's only modest evidence that the labor market is cooling off. Job openings are down a bit. As you know, quits are off their all-time highs. There's some signs that some wage measures may be flattening out but not moving up. Payroll gains have moderated, but not much. And in light of the high inflation we're seeing, we think we'll need to, and in light of what I just said, we think that we'll need to bring our funds rate to a restrictive level and to keep it there for some time. So what will we be looking at, I guess, is your question. So
Yeah.
we'll be looking at a few things. First, we'll want to see growth continuing to run below trend. We'll want to see movements in the labor market showing a return to a better balance between supply and demand. And ultimately, we'll want to see clear evidence that inflation is moving back down to 2%. So that's what we'll be looking for. In terms of reducing rates, I think we'd want to be very confident that inflation is moving back down to 2% before we would consider that.
Thank you, Mr. Chairman. Steve Leisman, CNBC. Can you talk about how you factor in the variable lags on inflation and the extent to which the outlook for rates should be seen as linear in the sense that you keep raising rates, or can you envision a time when there's a pause to kind of look at what has been wrought in the economy from
Here
the
we
rate
go. Come on.
increases? Thank you.
Sure. So, of course, monetary policy does famously work with long and variable lags. the way I think of it is our policy decisions affect financial conditions immediately. In fact, financial conditions have usually been affected well before we actually announce our decisions. Then changes in financial conditions begin to affect
Nice bounce on
economic
50%
activity fairly
retracement
quickly,
level
within a
of
few months.
368.
But it's likely to take
3868.
some time to see the full effects of
I did
changing
not
financial
take that
conditions on
trade.
inflation. So we
Should've.
are very much mindful for that. And that's why I noted in my opening remarks that
I
at
didn't
some
know Steve
point, as
Leeson
the
was
stance
gonna
of
throw a
policy
softball
tightens
out
further, it will become
Yeah.
appropriate to slow the pace of rate hikes while we assess how our cumulative policy adjustments are affecting the economy and inflation. So that's how we think about that. Your second question, sorry, was?
Is there a
So guys,
point
if you
in time
see
you
that,
see pausing? Is it linear?
38,
Raising
68,
rates, or is
44
there-
was the
oh,
50% retracement level.
I should know
Nice
better than
dip
not
down
top
into
of my
it, nice
first
bounce
one.
out of it.
I should know better than to answer your second question.
Would have got you 20 points, Ty.
Oh, there you go.
Yeah.
Is it linear? Do you keep raising rates, or is there a pause that you could envision where you kind of figure out what has happened to the economy and give time to catch up in the real economy, the rate increase time to catch up in the real economy? Thank you.
So I think it's very hard to say with precise certainty the way this is going to unfold. As I mentioned, what we think we need to do and should do is to move our policy rate to a restrictive level that's restrictive enough to bring inflation down to 2%, where we have confidence of that. And what you see in the SEP numbers is people's views as of today, as of this meeting, as to the kind of levels that will be appropriate. Now, those will evolve over time, and I think we'll just have to see how that goes. There is a possibility certainly that we would go to a certain level that we're confident in and stay there for a time.
Man, you get everything bounced
But
now.
we're not at that
Right.
level. Clearly today, we've just moved, I think, probably into the very
Even got gold
lowest
bounce.
level of what might be
Gold's ripping.
restrictive. And certainly in my view and in the view of the committee, there's a ways to go.
Nice. There we go, guys.
Hi, Chair Powell, Rachel Siegel from The Washington Post. Thank you for taking our questions. The projections show the unemployment rate rising to 4.4% next year. And historically, that kind of rise in the unemployment rate would typically bring a recession with it. Should we interpret that to mean no soft landing? And is that kind of rise necessary to get inflation down?
Right. So you're right. In the SEP, there's what I would characterize as a relatively
target to
modest
the upside,
increase in the
guys.
unemployment rate from a historical perspective, given the expected decline in inflation. Now,
3925,
why is that?
3927, that's
So
kind of the box
really,
I'm
it
looking
is
at.
that is what we generally expect, because we see the current situation as outside of historical experience in a number of ways, and I'll mention a couple of those. First, and you know these, but first, job openings are incredibly high relative to the number of people looking for work. It's plausible, I'll say, that job openings could come down significantly, and they need to, without as much of an increase in unemployment as has happened in earlier historical episodes. So that's one thing. In addition, in this cycle, longer run inflation expectations have generally been fairly well anchored. As I've said, there's no basis for complacency there, but to the extent that continues to be the case, that should make it easier to restore price stability. And I guess the third thing I would point to that's different this time is
So,
that
Theo,
part of this inflation is caused by this
the
series
trade
of
was
supply
off the
shocks that we've
50%
had,
retracement
beginning with
level
the
of
pandemic and really
3868.
with
I
the
did
reopening
not
of the
take
economy,
that trade.
and more recently amplified and
But I would
added
be
to
taking
by
profits.
Russia's
It went
invasion
right
of
to the
Ukraine,
profit
have all
level that
contributed
they
to the sharp
expected.
increase in inflation. So these
Which
are
was the 320.
the kinds of events that are not really seen
Which was the
in prior
25
business
level in the
cycles.
ES.
And in principle, if those things start to get better, and we do see some evidence of the beginnings of that, it's not much
If
more
you
than
miss
that, but
the
it's
trade,
good to see
don't
that.
chase it.
For example, commodity prices look like they may have peaked for now. Supply chain disruptions are beginning to resolve. Those developments, if sustained, could help ease the pressures on inflation. So let me just say, how much these factors will turn out to really matter in this sequence of events, it remains to be seen. We have always understood that restoring price stability while achieving a relatively modest decline, or rather increase in unemployment and a soft landing would be very challenging. And we don't know. No one knows whether this process will lead to a recession, or if so, how significant that recession would be. That's going to depend on how quickly wage and price inflation pressures come down, whether expectations remain anchored.
Kind of got this double top
and
tie
whether,
at 25.
you know,
I've been
also,
kinda
do we get more
bouncing
labor
upward
supply, which would
target.
help as well. In addition, the chances of a
These are
soft
breaks
landing
in
are
the
likely
ES.
to diminish to the extent that policy needs to be more restrictive or restrictive for longer. Nonetheless, we're committed to getting inflation back down to 2% because we think that a failure to restore price stability would mean far greater pain later on.
Just to follow up on one small thing, are vacancies still at the top of your list in terms of understanding the labor market and how much room there is there?
Yes, vacancies are still almost 2-to-1 ratio to unemployed people. That and quits are really very good ways to look at how tight the labor market is and how different it is from other
And he's
cycles.
hammering on the jolts,
where,
isn't he, Bornelon?
where generally the unemployment rate itself is the single best indicator. We think those things have for quite a time now really added value in terms of understanding where the labor market is.
Nick, my boy
Nick
Nick.
Timros of the Wall Street Journal. You
There
said
he
not too
is.
long ago, in describing the policy destination, there's still a way to go. But I imagine you have to have some idea about how you're thinking about your destination, whether it's a stopping point or a pausing point. And so I was wondering if you could discuss how you are thinking about, as the data come in, where
This
that
is an important
destination
area
is,
where we
how
can
it's
see a
moving
bounce
up
out
if
of,
inflation doesn't perform
because we're bouncing
as
off
you
of
expect.
the
Do you want
scene
to
of the
have a
crime
policy
if we
rate
bounce
that's
it.
above the underlying inflation rate, for example? And do you have an estimate for where you think the underlying inflation rate might be in the economy right now?
Well, so, again, we believe that we need to raise our policy stance overall to a level that is restrictive. And by that I mean is meaningfully, putting meaningful downward pressure on inflation. That's what we need to see
Nice
in
little
the
double
stance
top there
of
on
policy.
that
We also know
2-minute
that there
chart on
are
the ES time.
long and variable lags, particularly as they relate to inflation. So it's a challenging assessment. So what do you look at? You look at broader financial conditions, as you know, you look at where rates are, real and nominal in some cases. You look at credit spreads. You look at financial conditions indexes. We also, I would think, and you see this this is something we talked about today in the meeting and talk about in all of our meetings, and you see this, I think, in the committee forecast. You want to be at a place where real rates are positive across the entire yield curve. And I think that would be the case if you look at the numbers that we're writing down and think about, you measure those against some sort of forward-looking assessment of inflation expectations. I think you would see, at that time, you'd see positive real rates across the yield curve, and that is also an important consideration.
Howard.
Hi, Howard Schneider with Reuters. Thanks for the opportunity. I just want to be clear on the steps. You say it's meeting by meeting, but it sure looks like we're going 75, 50, 25. Is 75 next month the baseline?
Good question.
So we make one decision per meeting, and the decision we made today was to raise the federal funds rate by 75. You're right that the median for the year end suggests another 125 basis points in rate increases. But there's another fairly large group that saw 100 basis points addition to where we are today. So that would be 25 basis points less. So, we're going to make that decision at the meeting. We didn't make that decision today. We didn't vote on that. I would say that, we're committed to getting to a restrictive level of for the federal funds rate and getting there pretty quickly. And that's what we're thinking about.
So,
All right,
just as a
75
follow-up to that,
it
I'm
is.
wondering about
Yep.
the sort of risk management considerations here, given there's some discussion now of overdoing it. What's the incentive to continue front-loading right now? Is it lack of progress on inflation seen in the CPI reports, or is it a motivation to get as much done while the job market is still as strong as it is?
So what we've seen is inflation our expectation has been that we would begin to see inflation come down, largely because of supply side healing. By now, we would have thought that we would have seen some of that. We haven't. We have seen
Transitory.
some supply side healing, but inflation has not really come down. If you look at core PCE inflation, which is, a good measure of where inflation is running now, if you look at it on a 3, 6, and 12-month trailing annualized basis, you'll see that inflation is at 4.8%, 4.5%, and 4.8%. So that's a pretty good summary of where we are with inflation, and that's not where we expected or wanted to be. So what that tells us is that we need to continue, and we can keep doing these, and we did today do another large increase as we approach the level that we think we need to get to. And we're still discovering what that level is, but people are writing that down in their SEP where they think policy needs to be. So that's how we're thinking about it.
Let's go to Colby. Thank you. Colby Smith with the Financial Times. Chair Powell, how should we interpret the fact that core inflation is still not forecast in the SEP to be back to target in 2025, and yet the dot plot projects cuts as early as 2024? And does that mean there's a level of inflation above the 2% target that the Fed is willing to tolerate?
So I guess core is at 2.1 in 2025, and in the median, and headline is at 2.0. So that's pretty close. I mean, we write down our forecasts and we figure out what the median is and we publish it. So it's not. I mean, I would say that if the economy followed this path, this would be a pretty good outcome. But you're right, it is a tenth higher than 2%.
Okay, just as a quick follow-up, I mean, if the concern is that underlying inflation is becoming more entrenched perhaps each month, then why forego the more aggressive 100 basis point increase today? And does that risk having to do more later on?
Yeah, so we, as we said, at the last press conference and in between that one and this one, we said that we would make our decision based on the overall data coming in. So if you remember, we got a surprisingly low reading in July, and then a surprisingly high reading for August. So I think you have to, you never want to overreact too much to any one data point. So if you look at them together, and as I just mentioned, if you really look at this year's inflation, 3, 6, and 12-month trailing, you see inflation is running too high. It's running 4.5% or above. You don't need to know much more than that. If that's the one thing you know that this committee is committed to getting to a meaningfully restrictive stance of policy and staying there until we feel confident that inflation is coming down. That's how we think about it.
Victoria.
Hi, Victoria Guida with Politico. I wanted to ask about the balance sheet. You all have left open the possibility that you might sell mortgage-backed securities, but we've seen significant slowing in the housing market. Mortgage rates have gone up significantly, and I'm just wondering whether conditions there might affect your plans for how quickly you have the runoff on the MBS side.
So what we said, as you know, was that we would consider that once balance sheet runoff is well underway. I would say it's not something we're considering right now, and not something I expect to be considering in the near term. It's just it's something I think we will turn to, but the time for turning to it has not come and is not close.
Well, and will conditions in the housing market affect that decision?
I think a number of things might affect that decision, but the main thing is we're not considering that decision, and I don't expect that we will anytime soon.
Thank you. Neil.
Thanks. Neil Irwin with Axios. A number of commentators have come to the view, and including over at the World Bank, that simultaneous global tightening around the world creates a risk of a global recession that's worse than is necessary to bring inflation down. How do you see that risk? How do you think of coordination with your fellow central bankers? And is there much risk of overdoing it on a global level?
So we actually, my colleagues and I, a number of my FOMC colleagues and I, just got back from one of our frequent trips to Basel, Switzerland, to meet with other senior central bank officials from around the world. We are in pretty regular contact, and we exchange. Of course, we all serve a domestic mandate, domestic objectives, in our case, the dual mandate, maximum employment and price stability. But we regularly discuss what we're seeing in terms of our own economy and international spillovers. And it's a very ongoing, constant kind of a process. So we are very aware of what's going on in other economies around the world and what that means for us and vice versa. The forecast that we put together, that our staff puts together and that we put together on our own, always try to take all of that into account. I mean, I can't say that we do it perfectly, but it's not as if we don't think about, the policy decisions, monetary policy and otherwise, the economic developments that are taking place in major economies that can have an effect on the U.S. economy. That is very much baked into our own forecast and our own understanding of the U.S. economy as best we can. It won't be perfect. So, I don't see it's hard to talk about collaboration in a world where people have very different levels of interest rates. If you remember, there were coordinated cuts and raises and things like that at various times, but really we're in very different situations. But I will tell you that our contact is more or less ongoing, and it's not coordination, but there's a lot of information sharing, and we all, I think, are informed by what other important economies that are important to the United States are doing.
Craig.
Nice little rise on
Craig Torres from
TLC here.
Bloomberg. Chair Powell, you talked
Make
about
rates
some
come
ways
down a little
the
bit.
higher interest rates are affecting the economy, but we've also seen a resilient labor market with durable consumption, strong corporate profits.
Listen to this.
And I'm wondering
dude.
what your story is on the resilience of the economy. After all, you and your colleagues said, well, we started tightening in March when we were talking about interest rates in the future. And indeed, Treasury rates moved up. So we should have had a lot of tightening taking effect. Why is the economy, in your view, so resilient? And does it mean that we might need a possibly higher terminal rate?
You're right, of course. The labor market in particular has been very strong. But there are the sectors of the economy that are most interest rate sensitive are certainly showing the effects of our tightening. And of course, the obvious example is housing, where you see declining activity and of all different kinds and housing price increases moving down. So we're having an effect on interest sensitive spending. I think through exchange rates, we're having an effect on exports and imports. I think so. All of that's happening, but you're right. And we've said this. This is a strong, robust economy. People have savings on their balance sheet from the period when they couldn't spend and where they were getting government transfers. There's still very significant savings out there, although not as much at the lower end of the income spectrum, but still some savings out there to support growth. The states are very flush with cash, so there's good reason to think that this will continue to be a reasonably strong economy. Now the data sort of are showing that growth is going to be below trend this year. We think of trend as being about 1.8% or in that range. We're forecasting growth well below that, and most forecasters are. But you're right. There's certainly a possibility that growth can be stronger than that, and that's a good thing because that means the economy will be more resistant to a significant downturn. But of course we are focused on the thing I started with, which is getting inflation back down to 2%. We can't fail to do that. If we were to fail to do that, that would be the thing that would be most painful for the people that we serve. So for now, that has to be our overarching focus. And you see that, I think, in the SEP, in the levels of rates that we'll be moving to reasonably quickly, assuming things turn out roughly in line with the SEP. So that's how we think about it.
Mike, thank you.
Thank you, Mr. Chairman. In a world of euphemisms that we live in here with below-trend growth and a modest increase in unemployment, I'm wondering if I could ask you a couple of direct questions for the American people. Do the odds now favor, given where you are and where you're going with interest rates, favor a recession? 4.4% unemployment is about 1.3 million jobs. Is that acceptable job loss? And then given that the data you look at is backward-looking and the lags in your policy are forward-looking and you don't know what they are, how will you know, or will you know, if you've gone too far?
So I don't know what the odds are. I think that there's a very high likelihood that we'll have a period of what I've mentioned is below trend growth, by which I mean much lower growth, and we're seeing that now. So the median forecast, I think, this year for among my colleagues and me was 0.2% growth. So that's very slow growth, and then below trend next year. I think the median was 1.2, also well below. So that's a slower. It's a very slow level of growth, and it could give rise to increases in unemployment. But I think that is something that we think we need to have, and we think we need to have softer labor market conditions as well. We're never going to say that there are too many people working, but the real point is this. Inflation, what we hear from people when we meet with them is that they really are suffering from inflation. And if we want to set ourselves up, really light the way to another period of a very strong labor market, we have got to get inflation behind us. I wish there were a painless way to do that. There isn't. So what we need to do is get rates up to the point where we're putting meaningful downward pressure on inflation, and that's what we're doing. And we certainly don't hope. We certainly haven't given up the idea that we can have a relatively modest increase in unemployment. Nonetheless, we need to complete this task.
Well, how will you know, or will you know, if you've gone too far?
It's hard to hypothetically deal with that question. I mean, our really tight focus now continues to be ongoing rate increases to get the policy rate up where it needs to be. And as I said, you can look at this SEP as today's estimate of where we think those rates would be. Of course, they will evolve over time.
Chris Rugaber.
Thanks. Chris Rugaber, Associated Press. I wanted to follow up with what you just mentioned about the labor market. You've said several times that to have the labor market we want, we need price stability, and you've suggested maybe there isn't a trade-off in the long run. But in the short run, there is a lot of concern, as people have been expressing here, about higher unemployment as a result of these rate hikes.
Theo, great job, man.
So
I'm glad you could trade with us.
What about high inflation now?
Had a great day so far. That's why I'm not over
The job
trading.
market. I mean, you seem to suggest that inflation, high inflation will eventually lead to a weaker job market. So can you spell
this
that
guy
out a
looks
little
like
more
he's
for the
done a
general
little
public
too
and
many
how that
drugs.
works?
So for starters, people are seeing their wage increases, their
little too much
wage
coke.
increases eaten up by inflation. So if your family is one where you spend most of your paycheck, every paycheck cycle, on gas, food, transportation, clothing, basics of life, and prices go up the way they've been going up, you're in trouble right away. You don't have a cushion, and this is very painful for people at the lower end of the income and wealth spectrum. So that's what we're hearing from people is, it very much that inflation is really hurting. So how do we get rid of inflation? And as I mentioned, it would be nice if there were, a way to just wish it away, but there isn't. We have to get supply and demand back into alignment, and the way we do that is by slowing the economy. Hopefully, we do that by slowing the economy, and we see some softening in labor market conditions, and we see a big contribution from supply side, improvements and things like that. But none of that is guaranteed. In any case, our job is to deliver price stability, and I think you can think of price stability as an asset that just delivers large benefits to society over a long period of time. We really saw that for a long time. The United States had 2% inflation, didn't move around much, and that was enormously beneficial to the public that we serve. And we have to get back to that and keep it for another long period of time. To pull back from the task of doing that is you're just postponing. The record shows that if you postpone that, the delay is only likely to lead to more pain. So, I think we're moving to do what we need to do and do our jobs, and that's what you see us doing.
Thank you for taking the question, Mr. Chairman. Edward Lawrence for Fox Business. So you had said that Americans and businesses need to feel some economic pain as we go forward. How long from here should Americans be prepared for that economic pain?
How long? I mean, it really depends on how long it takes for wages and more than that, prices to come down, for inflation to come down. And what you see in our in our projections today is that inflation moves down, significantly over the course of next year, and then more the next year after that. And I think once you're on that path, that's a good thing, and things will start to feel better to people. They'll feel lower inflation. They'll feel that the economy's improving, and also if our projections are close to right, you will see that that the costs in unemployment they're meaningful, and they're certainly very meaningful to the people who lose their jobs, and we talk about that in our meetings quite a lot. But at the same time, we'd be setting the economy up for a long period. This era has been noted for very long expansions. We've had 3 of the 4 longest in measured history since we got
good levels.
inflation under control.
Yeah, I've been listening on the background while I was
So when
finishing up my
inflation is
stuff,
low and
and,
stable, you
it's
can
been
have
fun to
these
watch.
9, 10, 11, 10-year, expansions, and you can see what we saw in 2018, 19, and 20, which was very low unemployment, the biggest wage gains going to people at the low end of the spectrum, the smallest racial gaps that we've seen in since we started keeping track of that. So we want to get back to that, but to get there, we're going to have to get supply and demand back in alignment, and that's going to take tight monetary policy for a period of time.
As a follow, what is that economic pain in your mind? Is it job losses? Is it higher interest rates on credit cards? What is that economic pain?
So it's all of those things. Higher interest rates, slower growth, and a softening labor market are all painful for the public that we serve. But they're not as painful as failing to restore price stability and then having to come back and do it, down the road again, and doing it at a time when actually now people have really come to expect, high inflation. If the concept of high inflation becomes entrenched in people's economic thinking about their decisions, then sort of getting back to price stability, the cost of getting back to price stability just rises, and so we want to avoid that. We want to act aggressively now, and get this job done and keep at it until it's done.
Thank you, Chairman Powell. Nicole Goodkind, CNN Business. Existing home sales have fallen for 7 months straight. Mortgage rates are at their highest level since 2008. Yet mortgage demand increased this week, and housing prices are still elevated. Now, at the end of your June press conference, you mentioned plans to reset the housing market. I was wondering if you could elaborate on what you mean when you say reset, and what you think it will take to actually get there.
So when I say reset, I'm not looking at a particular specific, set of data or anything. What I'm really saying is that we've had a time of a red hot housing market all over the country, where, famously houses were selling to the first buyer at 10% above the ask before even seeing the house, that kind of thing. So there was a big imbalance between supply and demand. Housing prices were going up at an unsustainably fast level. So the deceleration in housing prices that we're seeing should help bring sort of prices more closely in line with rents and other housing market fundamentals. And that's a good thing. For the longer term, what we need is supply and demand to get better aligned so that housing prices go up at a reasonable level, at a reasonable pace, and that people can afford houses again. And I think we probably in the housing market have to go through a correction to get back to that place. There are also longer run issues though with the housing market, as you know, where it's difficult to find lots now close enough to cities and things like that. So builders are having a hard time getting zoning and lots and workers and materials and things like that. But from a sort of business cycle standpoint, this difficult correction should put the housing market back into better balance.
Nice little drop here, Nick.
Shelter made up such a large part of this hot CPI report that we saw. Do you think that there is a lag and that we will see that come down in the coming months, or do you think that there's still this imbalance that needs to be addressed?
I think that shelter inflation is going to remain high for some time. We're looking for it to come down, but it's not exactly clear when that will happen. So it may take some time. So I think hope for the best, plan for the worst. So I think on shelter inflation, you've just got to assume that it's going to remain pretty high for a while.
Okay, we'll go to Jean for the last question.
Last question. Here we go, guys.
Hi, Jean Young with Market News. You've talked about the need to get real rates into positive territory, and you said earlier that policy is just moving into that territory now. So I'm curious, how restrictive is rates at 4.6% expected? Is that expected to be next year? How restrictive?
Sure. So I think if you look, when we get to, let's assume we do get to that level, which I think is likely, what you're going to do is you're going to adjust that for some forward looking measure of inflation. And, that could be, you pick your measure. It could be, there are all kinds of different things you can pick and you get. But what you'll get is a positive number. In all cases, you will get forward inflation expectations in the short term, I think, that are going to be, assuming that we're doing our jobs appropriately, that will be significant. So you'll have a positive federal funds rate at that point, which could be 1% or so. But I mean, I don't know exactly what it would be, but it would be significantly positive when we get to that level. And let me say, we've written down what we think is a plausible path for the federal funds rate. The path that we actually execute will be enough. It will be enough to restore price stability. So this is something that, as you can see, they've moved up, and we're going to continue to watch incoming data and the evolving outlook and ask ourselves whether our policy is in the right place as we go. Thank you very much.
Awesome. Pretty good, huh, Nick?
Yeah. Yep. No, oh, you're gonna, I think Tyler's away from his computer. You're gonna need to change his scene, I just realized.
Oh, can you, I just shared, I kicked him out. Can you see my,
Yeah. Yep. All good. All good. Cool.
All right, guys. Well, look, I mean, we had, I know you just popped in, Nick. Can you hear me?
Yep.
Okay. We had a really, really good trading day, positive 35 points on the ES. I mean, our levels, great levels. These were the levels that we gave out, the ones in the highlighted boxes. Here to the upside, to the downside. This was before the Fed even talked. They came right down. We had a nice buy zone right out of here. Nice double top rejection in here. So just good trading day. Good trading day. So and Tyler had some good levels that he popped in there. So guys, what you want to do is, not, I mean, if you traded with us or if you traded and you're sitting positive, just, call it a day, man.
Yeah.
Call it a day. But what are you thinking, Nick? I mean, we have the dollar kind of coming back down off of the highs. You got TLT going up, which means you got rates kind of pulling back down. I don't know, very muted response to this Fed. I mean, it looks like they want us to go back up.
Yeah. Yesterday's move almost looks similar to this, where we had that drop out and then people just kind of faded it back up a little bit. So I guess maybe the question is going to be what we do from here. It looks like so far it's been uneventful, but we got some time for the rest of the day. You got another 45 minutes, but I don't know, maybe we'll get something by the end of the week here. The thing is, this is the same. This has been the same for the Fed meeting all year. Every year is that the Fed telegraphs everything so far ahead of time that the 75 basis point didn't take anyone by surprise. I don't think anything that he said really took anyone by surprise. I didn't catch anything on the dot plot. But I don't know. No surprise. It's probably why people were, everyone always, there's always seems to be that boogeyman of, oh, we're going to get 100 basis point surprise, and then we don't. And then people are like, so is that good news or bad news? Because they're sheep. And so I think once the dust settles, we'll maybe see something. I could see us getting a squeeze in just because everyone is looking for the drop. Everyone came in looking for the drop. Everyone and their mother's looking for the drop. And so I wouldn't be surprised if we had a squeeze first, but I don't know. We'll have to see.
Yeah, I agree. I wouldn't be surprised either. So, we'll have to see where it takes us. I mean, I wouldn't be surprised of a nice little pop up here because, again, we really didn't go anywhere. I mean, to me, this has been a very muted response to where we are. And, you know, I mean, Powell came out and said, look, I have not changed my stance from Jackson Hole. And he's still doing what he's doing.
Yeah.
I mean,
Yeah.
I don't know, man. I don't know what else to say.
Yeah. Yeah. We'll have to see what we get from these people. Definitely have to
Yeah.
see what-
Yeah. Let's see what we get. And, but either way, very good day. Very good day for us. Guys, if you enjoyed it, man, you know, I think we're good. I mean, I think we had some good trades in here. So, yeah, I mean, look, he talked about the jolts a lot. You know, he talked about job openings.
My report.
Yeah, that's what we were thinking about you, Nick.
You know, pal, we've been watching the show, I guess. You know, I've been warning. Yeah.
Yeah, I mean, he talked a lot about the jolts. So I guess we'll see, you know, what that means.
Yeah.
You know, we're kind of getting the markets kind of going up and down, but I don't know. I don't know. It's just, this is very, for me, if you're looking at the daily charts in here,
Yeah.
very muted response.
Yeah.
So,
Yeah, I agree. But
you know, wait to see what we get at the end of the day. See, we'll be in Discord, guys. We'll be, you know, letting you know what we're seeing, if we see any difference. But we will we'll also give you our analysis as we kind of get on the show tomorrow at 2:00 at 1 o'clock. So we'll kind of give you where we see going forward tomorrow. So, but that's it. I'm gonna take a break. I think we can stop it here, Nick, because I don't want to ruin the good day that we've had.
yeah. Yeah, I don't blame you, and I think everyone else should probably do the same unless they see something really juicy. But cool. Alrighty, well, we can wrap that one up, and they'll be back tomorrow, guys, for the Vant Rant. See y'all later.
Good
Safe
stuff,
trading.
man. See ya.